Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and it is Friday, April 11th. So you know what that means. It is Investment Friday. I'm here with my good friend, Brad Haines, Chief Investment Officer of Juncture Wealth Strategies. And it has been a freaking wild week out there. So yeah, let's just go like
Come
right in,
on.
Brad. What's
It's
going
been
on?
easy. Just easy peasy. Markets
Normal,
up and down 1,200, 2,000 points. No big deal.
right? We see
Well,
this all the time.
yeah, so to your point, Hannah, this has been an extremely volatile week, both on the downside and the upside. We had the first part of the week, we sold off really significantly to the point where we were off 19 point some odd percent, I think on Tuesday. Well, Wednesday comes out and we spike. It was Wednesday around 1 o'clock. President Trump came out and said, "Hey, I'm going to pause the reciprocal tariffs." And if people, just to remind you, there's a number of different tariffs that are being applied. One is a universal tariff. That's 10% on every trading partner that the United States has. So that is still on. That's still active. There are industry or product related tariffs that are still on as well. Okay. Canada and Mexico still have the 25% tariff being applied. China, at the time, had a quite low tariff compared to what they do on Thursday, which is now I believe they're at 100 and some odd, 117, 148%,
145.
145, 145% tariff. And the Chinese came out that day and said, okay, we're going to basically match you for all your goods and services coming into China. So it's truly almost a reciprocal tariff there because it's the same.
Right. There's this 125 on US goods.
Yep,
And
that's
they said
exactly right.
that's as high as their tariff is going to go on the US. But we're going to talk more about some of the other leverage points that might
Well,
exist.
fortunately or unfortunately, depending on on how you're viewing this issue, China has a lot of arrows in the quill if they're willing to use them. Um, so because of that pause of those reciprocal tariffs on Vietnam and all these other trading partners, the market, and bear in mind, it was also very, very oversold. We were off essentially 14, 15% within 3 or 4 business days. We had sold off so quickly that there was a tension built up. And so when it started rallying, a lot of people think that a lot of shorts, people who were trying to make money on the downside, were actually had to cover.
Hmm.
So it's called a short covering rally, where they had to go in and buy back all the stock, okay, that they thought they were going to make money on the lower side, but now it was going up. So they were losing money pretty quickly. So they covered it, which added to the buying frenzy on Wednesday. But really, ever since Wednesday, Thursday, and Friday. Thursday, we were down pretty significantly. At some points, we were down almost a little over 6%. We ended around down 3%, a little bit more than that. And then today, we've actually ended up, 1.78% on the S&P 500. So all in all, it's a positive week. We actually made money on the equities this week, even though you probably feel as an investor that you lost a lot of money this week.
Right. And my God, there are so many topics that we could cover within this. I will say, I want to touch on a couple of the kind of highlights. President Trump did front run the market On Wednesday, he sent out not a tweet, but a Truth Social post that said, "Now is a great time to buy," in all caps, signed off DJT, which is actually the ticker symbol of his media company. And so we'll see what comes from that. That would be a classic insider trading move if he was Martha Stewart, let's say.
Well, and it's
One.
funny because I follow a lot of quant economists and financial market participants that use mathematical methods to determine trading patterns. And right before his announcement, there was a significant amount of buying to the point that one person or entity or someone purchased call options at 85 cents that were going to expire this week. So a day or two. Okay. So what that means is 85 cents per contract. That's $85 per contract. Okay. Well, that went up 2,000%
Wow.
when he paused tariffs. Now, I'm not a conspiracy theorist, but that seems pretty suspicious that someone makes 24 to 25 million dollars per amount they put in all in one day, knowing that this was going to expire here in the day or two. So, it's something that I think the SEC is going to be busy quite a bit. I know some members of Congress had traded as well. And so I'm sure someone's going to be called on the carpet or not. I mean, that's also if you're on the right side of the aisle these days, it seems like you can get away with some things. So we'll see. Yeah.
Yeah, that's one thing. If you're seeing that in the news, um, that is again, insider trading comes from sharing non-public material information. So that means the public doesn't know about it, but it is material, meaning it matters to your company, to the um, financial stability of your company. And in this case, we're not talking about the company, we're talking about the United States. Right. So that's the parallel there to insider trading. If you're seeing that headline in the news, so yeah, we'll see what comes from that, if anything. But yeah, it is a little
Unusual,
unusual.
suspicious, suspect for sure.
Sus, as my kids would say, that's sus.
That's us.
Real
Yeah.
real sus. And from there, the other thing that happened um, just this week with the tariffs happening. So Wednesday was the big rally. Wednesday was also the Treasury auction, correct?
For the 10-year. Yep.
For the 10-year Treasury note. Um, and so that's where we're going to go today. We're actually going to talk more about bonds, Treasury yields today, because this is a really fundamental underlying piece of the market. And there are a lot of countries that own a lot of American debt to the tune of hundreds of billions of dollars. So is it trillions?
It's
Literally that
trillions.
trillions of dollars that other countries own of our treasuries. Why do they do that? Because historically, over the last many decades, the US dollar has been the reserve currency of the world, meaning we are seen as the most stable, reliable, safe currency in the world. And so it's been a safe bet to buy a lot of American treasuries and your money is safe. Well, on Wednesday, and you're going to tell us more about this, but Wednesday, Japan got hit with a pretty good tariff, just like everyone else. And they weren't super appreciative of that. But what is Japan going to do? They're going to take matters into their own hands and start, unwinding, right? So they wanted to start selling their treasury bonds. They own a lot of treasury bonds. That rattled the market a little bit in the morning, right? And that's when Scott Bessent, who is the Treasury Secretary of the United States, had to do some management of the Treasury sale on Wednesday. And things turned out okay, but it kind of revealed what I think is a very prescient crack that we need to be aware of, and really pay attention to with the way that we fund our debt, the way that other countries invest in America. So tell us a little bit more. I feel
Sure.
like I'm being
Okay.
cryptic. I'm not trying to be cryptic, but
No, no, no. Let's
let's go.
let's take a step back a little bit. Now, what did the 10-year Treasury yield do this week?
It went
Okay.
way up, right?
Went way up. The low is 3.87%. It ended the week at 4.53%. That doesn't sound like a lot, but that is a massive, massive, massive move in the bond market for one instrument. Okay. It's important to understand that the bond market underpins everything in the financial and real economy. So, for example, your mortgage rate is based on what those yields are. Okay. The yields on US Treasuries impact how much you pay on your mortgage. They impact your credit card rates. They impact your auto loan rates, your student loan rates. They impact everything. They impact the value of your house, not just through your mortgage, but also the value of your house. Uh, it impacts the value of stocks. Okay. Because what happens is the US Treasury up until now has been viewed as what we call the risk-free rate. It's the rate that an investor can put his money in or her money in and know they're going to get it back with a certain level of return. And because the United States has been virtually risk-free from owning their Treasury debt, um, we were able to finance our debts at very, very low rates because the US dollar is the reserve currency, because we have such financial surplus in our country from investors overseas that they want to have dollars, so they buy our debt. Um, so it's been a very auspicious place to be, a really favored status, really. Well, with the new policies of tariffs, but also not just that, the narrative around the tariffs about casting our trading partners as enemies or as people that have been taking advantage of us have turned off a lot of trading partners and international investors. Well, to your point, as you said earlier, foreign investors own about 8.5 trillion of our debt, our U.S. Treasury debt. Okay. Now, they're probably not going to sell it. But what if they did? All of a sudden, you have a lot of supply coming on the market, not as much, the similar amount of demand. So your price goes down, your yields go up. And with the yields gapping up this week, partially because of those type of fears, but also partially because in Japan, overnight on Tuesday, so into Wednesday morning, um, there was a hedge fund that had executed or had a basis trade on that was levered 100 to 1. Okay. That basically arbitrages the US Treasury note yield to the futures. So sometimes they diverge just a little bit from each other. But if you can buy the Treasury, sell the future, and leverage it, you can lock in a pretty low risk, good return on your money for that period. Now, what happens in the downside of those trades is if things start to get a little volatile, that leverage, that extreme leverage can really wipe you out really quickly. And it's I haven't heard any names, but there is a high suspicion or high probability that there was a hedge fund that blew up overnight on Tuesday in Japan, which caused a lot of volatility in the bond market on Wednesday morning, which caused US stocks to fall, which is then what I think caused Scott Bessent and to convince President Trump to delay the 90-day tariff, the reciprocal tariffs for 90 days, because we were at the point, if things escalate in that area of US Treasuries, it affects liquidity within the financial system. Banks, insurance companies, the like, everybody has a lot of treasuries. So he was like, let's not get to the point where we need to have the Fed step in and provide liquidity. Okay. And so he did that, and the market obviously kind of rock and rolled on Wednesday.
Well, so let's do that one again. As far as why does it matter that yields go up? What does that mean? So just to, I think people don't know as much about the bond market, about
Yeah.
how mechanically how it works. So with a bond, if your price on the bond goes down, if your prices go down, your yield goes up. That's how it always.
Explain it really intuitively too.
Mhm.
Say I sell you, say I buy a bond for $1,000 and it's going to pay me 5%. So $50 a year in interest. Okay. And let's say the current market goes to 6%. So all of a sudden, new investors can get 6% for every, $60 for every $1,000 they invested, or 6%. Well, if I want to sell my bond, it's only paying $50. So as an investor, would you pay more or less than the $1,000?
Right. It'd be worth less than 1,000 because I would rather spend 1,000 and get $60 of
Exactly.
interest.
So the price goes down to adjust to make my bond yield 6% because that's the current market rate. All right. So conversely, if I have a bond paying me $50 in interest and all of a sudden yields go to 4%, same math, but just in the opposite direction. People will pay me more because they want that higher coupon. Okay. So it's very intuitive. You just have to sit and think about what happens. But in general, there's rules of thumb. Bond yields go up, bond prices go down, vice versa.
So then, again, at a mechanical level, why would it matter if, let's say China, we're going to go back to China, they have, I think I read 700 billion
Mhm. Ish.
of ish of US treasuries. So if they were to say, we don't want this anymore, we're going to go ahead and sell all of it, or even a big, even a large portion of it. What would that do? Why would that matter? Why would we need to understand what's happening there in the financial markets? Oh no, Brad froze for a second. There you are.
Okay. He
You're back.
froze. Yeah, I'm back. Okay, so I'll address that. Um, First of all, I'm going to address that China will not do that. And there's
Right.
a lot of other reasons. But if they did, what happens is all of a sudden you have $750 billion in treasuries that come on the market that need a buyer. Okay. Well, that's a lot of money. And some people would buy it, but the problem is that it's so much volume for other investors to absorb that the prices would naturally have to fall. And the reason they
Yeah.
fall is because there's no other buyers, excuse me, and it needs to fall to the point where people will go, you know what? I'll pick that treasury up. So I'm going to sell this other investment I have. I'm going to buy that treasury because now it's yielding X amount more. And that's really a great rate of return on something that I view as pretty low risk. So that's the problem. And that would ripple throughout the entire US economy because um, US Treasuries yields, like as I said, they are the risk-free rate, and they're part of what people use to value all investments, stocks, real estate, commodities, all of it. And so it impacts every single asset you own that you would consider an investment.
So again, same simple mechanics. If someone floods the market, if any one thing floods the market, we've got an oversupply, right? So prices are going to go down on those bonds. So yields, like we just talked about, yields are going to go up because the prices, now we've got a flood, prices down, the yield is higher. So let's say that pushes the yields back up into the 5%. Now we're back at a higher interest rate kind of throughout the economy, right? And so what does that do to the inflation rate? And what is the Fed thinking? What is Jay Powell thinking if that happens?
Yeah, so the reason why it's dangerous is because um, it spikes up the real yield, which is the real cost of interest on the U.S. economy. And so higher the interest rates, the slower the economic growth is going to be. So at a period like today or this week, where at a minimum, it looks like we're going to go into a stagflation type of environment with really low economic growth with higher inflation. Um, that becomes a real problem because now the financial markets are trying to slow the economy at a time where maybe the Fed doesn't want it to slow because of yields and interest rate policy. So that would encourage them to step in. Now, they've been pretty adamant that they're not going to step in unless they see something happen, like we go into a severe recession or, so economic growth falls off, kind of falls more quickly and more severely than they had anticipated. They'll step in and lower rates. Um, but because these tariffs are supposed to have a very temporary impact on inflation, that means they don't want to overreact to inflation and either keep it more elevated than it otherwise would be, or to push it down, um, and do more further harm to the U.S. economy.
So does this effectively not force their hand, but if interest rates go up in the bond markets, kind of naturally, not necessarily naturally, but because of, what's happening, um, does that like take away that tool somewhat for the Fed, or does that blunt the tool?
Yeah, and I think that's their concern. We already have we already have certain indications of slowing economic growth, right? The jobs outstanding have been dropping off. That usually is a precursor to job layoffs. We have a lot of CEOs that are coming out and saying, "Hey, we're concerned because we can't forecast our revenues for the next year because of the tariff, the uncertainty surrounding tariffs." Um, so because of that, it certainly can put them on the back foot a little bit, and they can be real concerned about their dual mandates of controlling inflation and making sure everybody's employed.
Hmm. Right. So the other question that's coming up for me and has come up with, especially with clients asking these questions. I mentioned I literally had a client this morning who was asking about the bonds, the bond market, what's happening there, because there's a lot of talk, but not a lot of clear information. And partly because we also don't know, right? There's so much uncertainty. Like you said, like companies aren't really able to forecast what Q2 is going to do at this point, right? If any of their production is coming from China, or Vietnam or any of these other like very um, where things are manufactured, where the factories are cars, our auto industry, Canada, Mexico, all of that, we can't forecast. Big companies can't forecast. Small companies can't forecast. I've also seen plenty of videos of small founders of very small companies, like 5 to 20 employees, who have pieces of their products manufactured in China or Vietnam because those are literally the only places in the world with the capacity with those particular abilities. And now their material that they then ship back to the United States and then complete the assembly of their products is going to be 145% higher than it was. So that's double plus another 45%. from what they expected when they sent those orders over. And so where that one of the things that I'm especially concerned about, um, as someone who works with a lot of small business owners and who also recognizes, that 99 or so percent of the businesses in the US are considered small, right? Like we are
Yeah.
we are a nation of small business. Like that's a huge engine of our economic um just underpinnings is small business in America. And so having this level of unpredictability. I don't even want to like uncertainty doesn't give it the right credence to me. Like that's not the right word anymore. It's the unpredictability. I think that's really, really hard for small businesses at this moment. So I am just talking for a second here, but what do you see as, especially in this trade war that we're now in with China, even though it's only been a few days at this point, it's like it's escalated so quickly. What what do you think might be some of our options to back out of it? What would be if we did back off completely? What are the ramifications still? What are you thinking?
So one of the ramifications, even if we dropped every reciprocal tariff today, or every tariff on our trading partners today, would be the harm to the United States reputation. We have shown people, either by our narrative, our comments, or our trade actions, that we are no longer reliable partners in any sphere. We're just not reliable partners for anybody. That's a dangerous place to be in. That's not a good place to be in. Um, we talk about globalization, and the country that has benefited the most from globalization is the United States, hand over fist. No one even comes close. We garnered more benefit from globalization and shipping manufacturing overseas than any other country in the world by far, which is why we have the highest standard of living. And I think that's getting missed in a lot of this commentary, is other countries have been ripping us off. Not really. Not really. We've been actually benefiting by low cost products coming in, where now your average wage goes that much further. Well, right now we're in the exact opposite, where now your average wage is shrinking. And the reason why is because they want to bring all manufacturing back. Well, that's just not how economies work. Um, so, uh, so I think that the damage to the reputational damage is significant and will take years and years to overcome. Um, in terms of China specifically, uh, China China and the United States are married and joined at the hip, regardless of either country's leader, whether they like it that way or not. Um, they make our stuff, we buy the stuff. And if they can't necessarily replicate or replace the US consumer, just like we can't necessarily replicate and replace the Chinese production. And even if we could, it would take 10 to 15 years.
Right.
So these are not short-term trends that we're going to put into place. My guess is Xi is going to play a couple cards, and he's going to make Trump blink. And Trump will blink, because he's not good at sticking with anything really, but sticking with a policy. And particularly if it starts harming the US economy too much, um, he's at a difficult point. I think we've talked about in this past that he's got less than 9 months. If we go into a recession in the next 9 months because of his tariff policy, he's I think that the MAGA Republicans will lose the House of Representatives and the Senate.
Hmm.
If that's the case, then Trump is under a very real possibility of being removed from office by the Congress, being impeached by the House and removed by Senate. So does he want to go down that path? I think he's I think he I don't know if he's the smartest guy in the world, but I do know he's pretty sly from a political standpoint. And so, do I think Trump wants a recession right before the midterms when really the margins are so thin? I gotta believe no.
Mhm.
So that's why I think he's eventually going to blink. He's eventually going to somehow come out, whether it's the summer or what have you, and say, oh, well, China, Xi's my friend, and China made this great deal. And we're gonna we're gonna we're gonna jointly lower our tariffs to 30% or whatever. Okay. And then we're gonna be back on the path. Um, he can couch it as a political win to his base. The equity market will go up quite a bit, and there will be more certainty around business.
Mhm.
Um, as of right now, I think the 90 days, I think was a temporary relief, but I do not think by any stretch of the imagination it's a good thing. Right now, our average tariff, even without the reciprocal tariffs, is around 24-25% on average because of the Chinese ones that are so high, effectively turning off trade between the two countries, which is the largest trading relationship in the world.
Right.
So, you know, I think they've lent us money that we spend on their goods and services, and that we get to use, and we get to garner financial wealth off of it. So I just think that we're in bed with each other, and if you want to separate, it's going to be decades of work to separate those two economies.
Yeah.
Um, so
Yeah, that was and that's come up in a lot of discourse lately too, is that these two, we talked about this a little bit, there's two mutually exclusive goals of that have been vocalized about these tariffs. Either it's to bring back American manufacturing
right.
or it's to get better trade deals. And
Yep.
so the number two, get better trade deals, that is implying free trade, right? That's implying that we want more free trade if we want better trade deals.
I would say more flexible trade,
Hmm.
not necessarily free trade, because it implied trade deals implies that you may have low tariffs, but
Right.
not no tariffs, right? So, and I do think he's using it as a negotiation tactic. However, the way he's going about with certain countries, I mean, I think he misunderstands the Chinese culture to the point of you don't embarrass a person you're trying to negotiate with. You do not embarrass them in public.
Hmm.
You do not do that. That's not a way to negotiate in China,
Right. I would say
because
not in any Asian culture.
no, not in any Asian culture. So it's to me, it is Xi has to say, okay, well, if I relent, now I lose face, I lose honor. So that's never ever going to happen. So that's why my guess is China throws a little bone to Trump, and Trump jumps at it. But it still constricts global trade pretty significantly. Um, so
Well, and I would like to also bring into the conversation just for us to like think about and to chew on for the future that globalization has been the way that we have created more millionaires and billionaires in the last, several decades because of the scale of globalization. And that's been throughout the history of humanity. If we go back and look at economics from centuries past, the more insular your economy is, all your goods and services that you just trade within your little group, that's all you have. Right? It's when you open up yourself to trade with other people, like, oh, we can grow this really easily, and we have more than we need. So we're going to trade with this group that can grow this other thing really easily, and they have more than they need of that. Right. When we do that, when we've done that as people groups, every time we have reached new markets, that has created more prosperity overall. So there's there's a lot to be said socioeconomically about globalization, about those factories where people are being paid really low wages, right? Is that the right thing to do? No, I don't believe we should be having our clothes made in sweatshops, right? There, I mean, there's a lot, again, there's so many things that these topics touch um, economically, but at the base of it, it's that when we allow ourselves to trade with more people, that's what opens up more lanes of prosperity for more people to elevate their position economically, right? To live easier, more prosperous lives, to get out of extreme poverty. Um, so can we do that? Can we shift our global economy in a way where we still have these strong trading partnerships and we're not taking advantage of other people and other people aren't taking advantage of us, right? Since that's kind of the talking point that we're working around, right? Not wanting to be taken advantage of anymore, which again, we've talked on this. We don't believe that as in the US, we are the ones being taken advantage of.
Yeah, I mean, I think, and I don't want people to misunderstand my position. I think tariffs are an important tool for certain things, certain areas, certain products, certain industries that need to be protected, that are vital to national interest, meaning defense industry, shipbuilding, certain types of manufacturing. Those need to be fostered and protected however we do it. Okay. I think tariffs are one tool. I think the way that the Trump administration has applied it is they took a scalpel or they took a machete to something that should have been done with a scalpel. So I just think it was very clumsy how it's been being rolled out and communicated, which has caused a lot of the volatility in the bond and equity markets because they are they're causing a lot of international partners to be nervous. Okay. I mean, U.S. trade, U.S. tourism from Canada has almost shut down.
Right.
And I'm not sure people understand that you have Canadians that are so angry with the United States that they are literally not buying American goods and they're not coming to the United States on vacation or business meetings. So kind of a wild stretch for one of your closest allies. Um, but outside of those protected places, those industries, um, I think it should be more of a free trade feel. Um, it's interesting to me that the tariffs get applied and they include agriculture products, and other countries retaliate, and all of a sudden you have the American farmer who overwhelmingly voted for President Trump. Now they are concerned because they are on the worry. They're worried that with the tariffs they will not be able to survive growing the crops that they do and they want to sell. And you know what? That's not free trade, is to get bailed out by the federal government because the person you voted for did something you didn't like, you
Well, I
know?
think it's worth noting that in 2017, so the first time we dealt with tariffs,
Yep.
we the farming industry did get bailed out. The
Yep.
agricultural industry got humongous subsidies
Yes.
because
But
literally because of in response to the tariffs that Trump put on in his first term.
yeah, which makes no sense to me. So you tariff a product and now you have to through the right hand, your left hand tariffs, your right hand has to to support the agricultural industry. That makes no sense. Why don't you just remove tariffs or negotiate lower tariffs on U.S. ag products being exported? But
Right.
that's not what happens. So to me, it's a weird, you know, it's a weird thing.
Yeah. Right, right.
So
When we look at it from like a holistic standpoint of like, okay, what's actually happening in the economy when you do this? Um, the math doesn't math very well.
no, no,
So,
and I mean and I'm not sure what what changes it. I do know tariffs on agriculture products are probably not the best idea. Um, you know, we export a tremendous amount of food around the world, and our farmers do a fantastic job. So if I was him, I would exempt those. I just would. The problem with agricultural commodities are they're very easily replaceable.
mhm,
We're not the only country in the world that grows food. We have very good food and we have very high yields, generally because we have the best technology. But at the end of the day, lots of other places around the world can grow food and they can sell it. So the international substitution is there for other countries. So it's so efficient of a market in the sense of price that in elasticity, it's almost 100% elastic, So to me, it's something that they want to not do. They should exempt those for sure.
well, we will see what next week brings. So trading is done for the week. Everyone take a break. Brad, you get to not not wake
No,
up to insane futures news tomorrow, right?
well, there were certain nights I didn't even go to sleep. So what I would say is to all our viewers and listeners, look, this is not over, okay? But it's not at the end of the it's not this is a this volatility can go away
Mm-hmm.
really quickly. And we saw that on Wednesday. One
Right.
announcement of one part of the tariffs, and the market really went up quite a bit. So people are assuming already embedded in the market is the assumption that Trump is going to modify these tariffs, that he's not going to let us go into a severe recession, which, if he did keep them as announced, probably would cause a pretty severe recession.
Mm-hmm.
So again, because he's a political animal by nature and he's pretty savvy in that realm, clearly. So I just don't see him sticking with it and watching the U.S. economy go into a severe recession right before his party needs to win a bunch of elections. I just don't see it happening. So just keep with us. Bear in mind, it's going to be real volatile here between April and July. That's kind of the period that I think is going to be the max volatility. And then after that, I think we'll be set on a more steady course.
Yeah. And so as we've been saying, like if you have your investment plan set, stick with your plan, stay, not gonna use, well, you can stay the course, use the plan that you have created. Um, don't want to be the one, chasing, selling out when the market goes down and then trying to buy in when the market's going up, right? That is literally the recipe for just losing money over time. And getting those terrible, oh God, I've seen, maybe we'll share one of those charts sometime. Like what's the average retail investor return? Um,
Oh, yeah.
it's rough. It's like 2 to 3% per year.
Yeah, it's terrible. And it's not because their investments are bad, it's because they buy and sell them at the wrong time.
Right. Right. So just know that that's what we're teaching. That's what we're educating you through, especially in this podcast, is how to stay invested, how to have, that the wherewithal to to get through these really volatile markets. So thank you, Brad, for being
Welcome.
here. And again, Friday, April 11th, we'll see what next week brings. And whatever it is, we'll talk to you about it next week.
Sounds good.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.